The Property Bulletin by London Property, the home of superprime.
A recent workshop hosted by Pegasus Insight, featuring contributions from HomeTrack Zoopla and the National Residential Landlords Association, has highlighted a pressing need for policy stability in the private rented sector, PRS. The message from over 20 industry organisations was clear. Constant government changes risk pushing landlords out of the market, reducing housing supply and driving rents even higher. Key findings include shift in ownership. In 2010, 78% of PRS landlords owned just one property. By 2024, that number dropped to 45%, with 20% of landlords now controlling half the market. Impact of legislation. The anticipated Renters' Rights Bill has alarmed 81% of landlords, primarily over the removal of no-fault evictions, alongside concerns about potential changes to capital gains tax, CGT, a worry shared by 85% of landlords. Changing investment behaviour. Facing these challenges, 81% of landlords plan to be more selective with tenants, 62% are likely to raise rents, and 23% intend to cut back on maintenance expenses. Notably, only 5% of landlords expect to expand their portfolios this year, a steep decline from 18% in early 2022. Future housing demand. With an estimated 150,000 new PRS households expected annually until 2036, against the current addition of just 45,000 dwellings, the need for a stable investment environment is critical. Industry experts warn that without a pause on further legislative and tax changes, landlord confidence could weaken further, worsening the UK's housing crisis. Stability, evidenced by the recent decision in October 2024 not to hike capital gains tax on second property sales, remains essential for nurturing the sector and ensuring future investment. This call for policy consistency serves as a reminder to the government. A stable framework is vital to sustain and boost investment in the PRS, thereby supporting the broader housing market. A UK court has ruled that the Vatican was utterly let down by Italian financier Raffaele Mincioni in its failed investment in a luxury London property, which resulted in a loss of approximately €140 million when sold in 2022. Mincioni had taken the Vatican to London's High Court, seeking declarations that he acted in good faith regarding the deal. While the court declined to grant this, it did approve most of the other declarations he requested, and dismissed the Vatican's claims that Mincioni and his companies were part of a conspiracy to defraud the Church. I am proud as a British citizen that these matters have finally been examined by a truly independent judicial system, which has exonerated me of dishonesty, fraud, or conspiracy, Mincioni said in a statement. The botched investment led to a high-profile corruption trial at the Vatican, uncovering internal conflicts at the highest levels of the Catholic Church. The case concluded in December 2023 with the conviction of a cardinal, Mincioni, and others. Mincioni is appealing his conviction and has also filed a complaint with the United Nations human rights body. Archbishop Edgar Peña Parra, a senior aide to Pope Francis, testified in Mincioni's UK lawsuit last year. Mincioni and companies in his WRM group had sought various declarations regarding their dealings with the Vatican, including confirmation that they acted in good faith throughout the transaction. In a written ruling, Judge Robin Knowles stated, "On the facts shown at trial, the claimants fell below the standards of communication with the state, the Vatican, that could be described as good faith conduct." He added, "The state had good reason to consider itself utterly let down in its experience with the claimants. The claimants made no attempt to protect the state from fraudulent bad actors." Despite this, Mincioni welcomed the ruling, saying, "I hope the judgment can lay to rest once and for all claims that I am dishonest, a fraudster, or a criminal." The Vatican has not commented on the ruling. The rising cost of home ownership has led many to renovate rather than relocate. However, as the government moves forward with leasehold reform, it must be mindful of the broader economic consequences. Given that many residential freeholds are owned, directly or indirectly, by UK pension funds, a poorly executed reform could destabilise property markets, shift value to foreign investors, and undermine the UK's appeal as an investment destination. The government's commitment to leveraging institutional capital for economic growth is encouraging. However, one of its first tests will come from an unexpected area, leasehold reform. Many residential freeholds are backed by major financial institutions, including regulated pension funds, which operate under strict stewardship principles. These principles not only ensure responsible long-term investment, but also provide stability for leaseholders. Labour claims that their approach to reform, led by Housing Minister Matthew Pennycook, is more measured than the previous government's handling of the issue. Pennycook has acknowledged the complexities of leasehold reform and committed to a full parliamentary consultation process before implementing changes. However, Labour must learn from past mistakes. During the passage of the Leasehold and Freehold Reform Act 2024, the previous government explored retrospectively capping ground rents. This move, according to Labour, would have interfered with established property rights, undermining investor confidence and shaking the foundations of the residential property market. Had the government pursued retrospective ground rent caps, Labour claims, it would have sent a damaging signal to institutional investors. Many rely on the stability of English contract law, viewing the UK as a secure place to deploy capital. A policy that significantly reduces or restricts ground rents, either now or in the future, would contradict the government's stated commitment to a business-friendly environment. At stake are the future pensions of working people. Pension funds invested in freehold assets would have seen their values plummet, reducing their ability to reinvest in the UK economy. Moreover, most leaseholders are not UK-based landlords or homeowners, but rather international investors. In some areas of England, foreign buy-to-let owners represent more than 80% of leaseholders. Retrospective ground rent caps would have effectively transferred value from UK pensioners to wealthy overseas property investors. The financial impact would have been severe, with the previous government estimating potential compensation claims running into the billions, at a time when public finances are already stretched. Government stamp duty revenue increased by £40 million in January 2025, reaching £848 million, a 4.95% rise from last year, according to HMRC. The spike is attributed to a surge in property transactions, as buyers hurry to complete purchases before March the 31st, when stamp duty thresholds return to pre-tax holiday levels. From April the 1st, 2025, the nil rate threshold will drop from £250,000 to £125,000, doubling the average SDLT bill from £2,028 to £4,528. First-time buyer relief will also be reduced, and second home buyers are already paying a higher 5% surcharge since October's budget. Experts warn that buyers unable to complete in time will face thousands in extra costs, potentially renegotiating prices or delaying purchases. Since 2022, the Treasury has collected £31.3 billion in SDLT receipts. While the rush to buy has temporarily boosted government revenues, experts caution against further tax hikes, which could destabilise the market. Looking ahead, higher SDLT costs may deter some buyers, but growing confidence in the market due to falling interest rates could offset the impact. With the over 65 population projected to exceed 17 million by 2040, the UK faces a critical shortage of suitable later living housing. The Older People's Housing Task Force estimates that 30,000 to 50,000 new homes are needed annually to meet demand, yet only 7,000 are currently being built. Key recommendations from the task force report include age-friendly housing, homes designed for accessibility, dementia care and cultural inclusivity, independence and safety, enabling older adults to live safely and independently, community engagement, promoting social networks and well-being, health benefits, reducing hospital admissions by preventing falls, economic impact, encouraging downsizing to free up family homes, easing the housing crisis, workforce and support, addressing staff shortages in elderly care. The report calls for urgent government action to expand housing options, aiming to ease pressure on health and social care systems while improving elderly well-being. However, given the UK's financial constraints, the private sector is expected to play a major role in delivering new housing models and tenure solutions. New research reveals that hundreds of landlords have built lucrative short-term rental empires in London, with some owning over 20 properties each. Short-term lets now account for 3% of London's housing stock, rising to 40% in Westminster and 35% in Kensington and Chelsea, according to Savills. This raises concerns over housing affordability. Landlords earn £450 million annually from short-term lets in Westminster alone. Westminster Council warns that the rise in short-term lets is driving up rents and reducing access to affordable housing. 1% of hosts own 24% of all short-term rentals, out of 117,000 in London. There is a regulatory push for stricter controls. London's 90-day rental cap is often ignored, with calls for tougher enforcement and planning regulations. Labour-led councils, including Camden and Westminster, argue that the short-let market is straining local services and worsening the housing crisis. Mayor Sadiq Khan stresses that short-term lets should not be a loophole for commercial landlords. The short-let industry has responded to these concerns. Airbnb denies responsibility for the housing crisis, stating that short-term rentals boost tourism and contribute £1.5 billion to London's economy. Councils argue that stronger regulations could protect permanent housing, support social housing projects and make tourism more sustainable. As pressure mounts, tighter controls on short-term lets may soon be introduced to interfere with the market, as authorities attempt to balance London's housing needs with its tourism industry.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.